Welcome to your final financial stop, where today we're going to be talking about the fiscal policy. What is it, how it works, and how it affects your pockets. If you'd like to learn anything from this video, share or subscribe to my page. Follow my Twitter, leave a comment if you have any questions. And lastly, follow my Patreon if you want to learn more about this information so that you can grow yourself into a financially free individual. The fiscal policy usually refers to government spending and tax policies that influence the economic conditions of aggregate demand and supply, employment, inflation, and economic growth. This is opposed to monetary policy, which is the central bank's job to manipulate interest rates and money supply. For more information about the Federal Reserve and how they influence your wallet, check out my Federal Reserve video in my bio. So with fiscal policy, during a recession, the government may lower taxes to increase demand and fuel economic growth. Whereas when we face inflation, a government may reduce their spending to combat an overheated market. Spending bills are usually drawn up and announced by the president. Congress then works on the bill. The House usually debates this first by changing, adding, or removing new and existing programs, and increasing or decreasing budget requests depending on the government's revenue, employment rates, and more factors. When that is passed, it will go to the Senate. If anything is changed, it must go back to the House and pass again without change. If all goes according to plan, the president signs the bill, and it typically takes a few months to fully affect the market, but upon the date of approval, price may be factored into the market already. It was originally thought by many financial professionals that fear and pessimism can lead to recessions and depressions, whereas excessive ebullience in good times could lead to inflation. Through government taxation and spending in moderation according to the market's conditions could counteract and stabilize the economy. Expansionary and contractionary fiscal policies are vital to the survival of our economy in cases of massive doubt or greed. With expansionary policies, people pay lower taxes, so the incentive to spend or invest is greater, leading firms to hire more and decrease unemployment. Other than lowering taxes, the government may choose to increase their own spending by building highways or funding organizations to increase employment and the circulation of money. Eventually, this leads to tough competition for labor, as there's too much money in the market, causing inflation and asset bubbles, resulting in fear and a downturn for the economy. Contractionary policies are when the government increases taxes or reduces public spending to slow down the circulation of money. This policy is rarely used considering political activists have a campaign to run and promises to decrease unemployment, raise wages, lower taxes, and improve public properties. So it's not unusual for the Federal Reserve to pick up the slack by increasing interest rates and restraining the supply of money to combat inflation rather than the government acting on its own. Sometimes a change to the fiscal policy can have different effects on different demographics. For example, the funding of public highways and buildings could employ thousands at a time, whereas spending money on a space shuttle or wind turbines only employs a specific sector of the workforce. Despite the effect COVID-19 had on the global economy, the president has signed a $1.2 trillion infrastructure bill in November, paying for itself without raising taxes. This is to provide better roads, bridges, airports, public transport, water systems, electric vehicles, and much more. Also in 2021, the House has passed the Build Back Better Act. This is a $1.75 trillion social policy and climate change bill. The Congressional Budget Office forecasted the spending package was unlikely to affect the budget much, with the plan of heavier IRS enforcement against wealthy tax evaders. Senate has yet to vote on this bill, but we expect a decision to be made by early February 2022. So these next few months could prove to be very volatile in the stock market, with expectations of higher taxes and higher interest rates for businesses. And if you want a better idea of how the government and the Federal Reserve affects you, follow my channel with financial topics that are easy to understand and up to date. Thank you for joining me today. Like and share this video, follow my Twitter, leave a comment if you have any questions, and have a good day.